Dividend growth investors, bonjour, this is Mike Roux, founder of Dividend Stocks and passionate investor. I'm here to help you invest with more conviction so you can enjoy your retirement. I have to apologize, I was away last week and I couldn't put any video on the YouTube channel. The reason is it was the end of the quarter, and at each end of quarter at DSR, what we do is that we track over 1,000 stocks. We look at their quarterly earnings, we rate them, and then we make customized reports for our members. So you can imagine that since we have like over 1,000 members, it's a lot of work. So that's what I was doing last week, but now I'm back on this channel to tell you how to protect your portfolio against the next market crash. Brace yourself, winter is coming, and the next crash is coming. It's imminent. Because, you know, this is how the market works. I'm not telling you it's going to happen next week or next month or even next quarter, but the market goes up, the market goes down. Right now, we're on a uptrend. This is the perfect timing to make sure that your portfolio will not suffer too much during the next market crash. I think that COVID-19 will affect the economy once more. It will affect the market at one point in time because right now Wall Street is pretty much depending on whether or not the Fed is going to print more money. And one day or another, the party's going to be over and then the companies are going to go bankrupt and it's going to affect the economy, and you have to make sure that you're prepared for that. So what better move than to look at what happened in the past back in March and April of this year and make sure you don't replicate the same mistakes. So now let's pull my sector allocation pie chart, mostly because your asset allocation will be responsible for like 90% of your return. So if you're going to go very safe with bonds and preferred shares, your chances of suffering from a big market crash are not likely. On the other side, if you're like me and you're 100% invested in equities, then you make sure that your sector allocation is steady and well diversified, because if not, you might get hurt. As you can see, I am heavily invested in technology, financial services, and consumer cyclicals. Those are the pillars of my portfolio. And back in March, what I was telling my DSR member is, you know what, during an economic lockdown, I bet on Canadian banks and I bet on tech stocks. Tech stocks because we're all stuck in our house, so we need technology to continue working, to order food, e-commerce, and so on. So it's kind of obvious that you have to put some money there to make sure that it's in a safe haven compared to energy stocks, for example. And let's look at what happened between April and September after the market crashed back in March. Well, as you can see, energy sector is way down below, even though a lot of people were saying, well, Mike, I'm not going to sell my stocks in the energy sector. I'm going to wait until it bounces back, and then I'll be able to reduce my losses and invest in tech stock, as you mentioned. Well, if you have done that, you're still waiting because the energy sector is like up 15%, while the tech sector is up a lot more. I've pulled out a few of my stocks in my portfolio. So we're talking about Microsoft, Apple, OpenText, Logist. I've put out other examples like Henhouse and Broadcom that are not in my portfolio, but just to give you a pretty good picture, most of the tech stocks, even though if you're an index investor, if you've moved your money away from the energy sector and go into tech, that was a great move. Well, today is pretty much still the same, so you want to make sure that you have more tech than energy stocks. When the market crashes, you had energy, but you also had financial services and industrial sector that were greatly affected. We're talking about drops of like 35–40%. On the opposite side of the spectrum, you have consumer staples, healthcare, and tech stocks that were still hit, but it wasn't that bad. When you look at the graph, what you see is pretty much wherever you were invested back in March, you took a hit. So basically, the smart move to do at that time was pretty much to pull out your crystal balls back in February, sell all your stocks, and then invest on March 26th. I bet a lot of people didn't do that. Some of them saw that coming, saw the COVID coming, and then they sold. But Determining that March 26th was the bottom was impossible. Back then, I remember the panic was still going on. And then when we saw the small upside at starting of April, a lot of bear lovers were saying, that's a bull trap. It's just going to go back up a little bit and then it's going to go down even more by 20-25% and so on. Lots of confusion, lots of uncertainties. On my side, what I decided to do is just to keep it steady and not move too much of my portfolio, and actually paid well. In between April 1st and September 21st, 2020 is consumer cyclical went up, communication services and material sector. In the material sector, obviously you'll have gold stocks that thrived during the pandemic. Kind of obvious. Gold is a bet on fear. And there was a lot of fear, so definitely it was a good move to go there. I'm not a fan of gold. I already put a video about that. I don't believe in the yellow metal at all, and I prefer to have companies generating great income and paying me dividend instead. On the other side, a lot of people were saying, the market crash, I'm going to wait and I'll wait for the rebound and then I'm going to sell my losers. Well, if you go at the bottom of this chart, so what you can see is the underperforming companies were still lagging, especially the energy sector. Financial were like pretty much okay, but they were not part of those who had brought up the entire market on the upside. We're more talking about tech sector, obviously, and materials. Therefore, if you have been waiting to sell your loser, my guess is you're going to keep waiting for another quarter, another year, and then you're going to stick around with those. And you don't want that. You want to make sure that now you prepare your portfolio, and you know what? Energy is not going to be back anytime soon, mostly because there's a flood of demand, right? There's a flood of offer right now. The other problem we have is we don't have much demand. And I think that the economy is going to slow down for a while, and therefore don't expect to have an oil barrel around like 55 or 60 bucks anytime soon. And for that reason, you're better off to manage your portfolio in a different way and make sure that you're prepared if there's another crash. To give you more perspective, let's look at everything that happened in the first 9 months of the market. What you can see is, then again, tech sector, consumer cyclical, communication are at the top of the list. They did very well. Then you have a few stable sector like healthcare and consumer staples, which are pretty obvious. And then industrials like slightly lagging behind. And obviously REITs were affected as a sector because on the one side you have like high performing REITs such as data center and then cell towers, but on the other side you have brick and mortar retail REITs, which are all struggling. Financial sectors, energy still lagging behind for obvious reasons, and what you can see on the trend is a lot of them went back up quickly. For those who haven't, they're still lagging and they're not likely going anywhere right now. You don't see any trend, and it's going to be very difficult. I've already talked a lot about energy, but if you move to financial sector, it's going to be very difficult for US banks, especially, the classic banks that use just savings and loans. They're getting squeezed by the interest rates spread. When the interest rate goes down, that means they cannot charge that much when they do mortgages. So their loans are not going to be incredibly profitable. On the other side, the only way for them to compensate for the fact that they make less money per loans is to do more loans. Do you really want to make more loans right now in the middle of a recession where a lot of families are struggling, and we're still sitting on that ticking bomb because there's a lot of programs right now that allow families to defer their mortgage payment, but at one point or another, they'll have to make a decision there. Do they keep the house? Do they just give the keys and then they get away? Do they go bankrupt? So those hard questions must be answered, and it's not happening right now yet. The market is obviously anticipating that, but don't expect US banks to thrive in the future, especially if they're just classic regional banking. Go for banks that have asset management or insurance or capital markets segments, investment banking, anything that could help having a diversified portfolio. So now I'm putting these slides to show you which sector should grow, which sector should go down, and what to expect in the upcoming quarter. Well, I think the best bet is technology stocks again. I don't believe that we're in a bubble yet. Remember what happened in the tech bubble. A lot of companies were losing money. They were burning cash, but they had clicks and views, like page views. How can you make money out of page views? Now we're talking about companies like Apple and Microsoft that are making a lot of money, and they're sitting on billions of dollars in cash in their bank account. This is completely different, and we have a lot of innovation going on with the Internet of Things, with artificial intelligence. There's a lot of technology being added into the automotive and the industrial sectors to make us more profitable and more effective. And finally, the 5G is coming up. So there's plenty of industries in the technology sector that you can bet on and should go well. If you're patient enough, you should look at industrial stocks. They're old, they're big, and they're boring, but they're cyclical. And what's nice about cyclical stocks is you can buy them at a very cheap price. Then I've already discussed apartment REITs in a previous video. You can look into the link description. I'll put that there. You have my favorite apartment REITs over there. And then Canadian banks. I love Canadian banks because they're backed by the government. They work in an oligopoly, and they're just being very well diversified. So it's not just banking and loans, but we're talking about insurance, capital markets, wealth management. They expand their exposure to to the US, some to Latin America, some others in Asia. So they are very well established. On the okay side, like the stable side, you obviously have like the common recession-proof sectors. So consumer defensive, healthcare, communication, utilities. Those are your safe bets. Chances are that if we have another rise of the virus, consumer defensive and healthcare are actually going to thrive and go even higher. But you know, this is no secrets right now. There's a lot of money that went there already and it's not gone yet. So don't expect incredible return, but I think that they're gonna stay the course and they will help you survive through your portfolio. Now, if you want to make a few bets, well, US banks, consumer cyclical, depending on the trends, depending on the subsector, they may do very well, they may do terrible. So this is why I put like arrows ups and downs. Those are going to be sectors with a lot of volatilities, and I'm not too sure what's going to happen. If you look at energy stocks, I don't believe in those. I've been pessimistic about them since the foundation of 2000 and 2013 of DSR. So it's been 7 years I'm telling my members I don't like energy stocks. It's not changing today. The biggest reason why is they depend on commodity price fluctuation to pay their dividend. Not gonna happen. They make very poor dividend growers for that reason, and I just don't want to bother with a sector that does not fit with my investing strategy, and that you should not too. So if you're looking for catching stocks in a cyclical way and then bouncing back and buy and sell, energy sector is probably for you because there's a lot of volatility and there's a lot of money to be made. But if you're looking for something very stable, you don't want to look at your portfolio too much, and you just want to make sure that you cash some healthy dividend, I'm not a fan of the energy sector. Basic materials, pretty much for the same reason. It all depends on commodity prices. I know that there's a lot of hype around gold right now. That's pretty much the only sector that looks like it's safe. The other basic materials are not necessarily very interesting. And I'm not a fan about gold because it's always the same story. What you read right now, just pull out the same arguments and the same research titles and then put 2008, 2009 besides your research, and you're going to read the exact same theory that was written 12 years ago. What it tells me is when there's a market crashes and there's fears on the market, you have a lot of people telling you that gold is the 8th wonder of the world. Well, you know what? Let's wait 3 years. My guess is it's not going to go over $2,000 in 3 years from now. It's probably going to go back to like $1,500, and then the hype will slow down and they will not have anything else to do with that. Finally, retail REITs, pretty obvious. It's lagging for a while now, and I would not touch that sector at all. If there's another economic lockdown, if we're hit by a stronger wave than expected for the virus, which is pretty much what's happening right now in October at the time of recording this video, you know, I just don't see how they're gonna thrive. I think it's a real risky bet. You may want to take it. I don't. It's up to you, right? That's the beauty of investing. We all have our strategies and our thoughts, but I would not go into this one. So now the other thing that you can do, besides once you have selected the sectors that you want, is you have to consider payout ratios and how safe the dividends are in your portfolio. And for that reason, I would like to invite you to my next webinar, which will happen next week on Thursday. And if you watch this video and you're late, don't worry, you can still click on the link right below in the description box, register for the webinar, and any attendees or registered attendees will access the replay. So if you cannot make it live session, no worries, you register there, it's 100% free, and then you're going to be redirected to the replay right away. So it's kind of a pretty good deal, right? So in this webinar, I'm going to talk about how you can make sure that your dividends are safe and how you can master payout ratios and understand how a company like Enbridge, for example, which has a payout ratio well above 100%, is still paying a dividend that is safe, and it's still actually increasing their dividend year after year. So how can they manage that? Well, there's a secret, and I'm going to tell you next week in my webinar. So hope that you have enjoyed this video. I hope that it gives you a good perspective on all the sectors and how you can protect your portfolio about that, and make sure that you stay invested until our next video, and we'll talk again next week. Cheers.